fellow investors, and welcome back to Borex Investing. One of the companies I profiled in the past, Grab, the Southeast Asian everything app, just dropped their Q2 earnings, and there's a lot to talk about. In this quick video, I'll break down the key numbers, what's driving their growth, and whether I think the stock is still a buy after this report. I'll also share Wall Street's latest price target upgrades at the very end, so stick around for that. All right, let's start with the headline numbers. So Grab pulled in $819 million in revenue, which was up 23% year over year. So that's some pretty solid top line growth. Even better, their adjusted EBITDA came in at $109 million, which was a 69% jump from last year. And their free cash flow hit $112 million, which was a massive 177% improvement on last year. So these guys are showing that they're not just growing, they're actually becoming efficient. And here's the real kicker. They posted $20 million profit this quarter. So that's a huge turnaround from the $68 million loss they had last year. So bottom line, this is no longer just a high growth app story. Grab is now generating real profits and real cash, which marks a big shift from how it's performed in the past. All right, so let's talk about what's actually fueling this growth. First up, mobility. Gross merchandise value in this segment, GMV, was up 19% year over year. The user base grew 16%, and total ride transactions were up a solid 23%. So that tells me more people are using Grab to get around, and they're using it more often. Now, on the delivery side, GMV jumped to 22%, and what's really interesting here is how much of that growth is being driven by new product features. Things like saver deliveries, prepaid meals, and omni-commerce tools have now made up 33% of total GMV, and this is up from 15% just a few quarters ago. So they're scaling both mobility and deliveries, and they're doing it in a very smart way with product innovation and tight control over user incentives. So this isn't just growth at any cost. It's strategic and it's working. All right, if we take a look at Grab's financial and ecosystem plays, their loan portfolio just hit $708 million, which is a massive 70% year-over-year increase. So most of that is coming from ecosystem lending and their digital banks like GXS and GX Bank. So while their fintech is still unprofitable overall, it's scaling pretty fast, and I think it's clear that they're building a financial layer around the core platform. All right, then there's their advertising. They're now doing $236 million in annualized ad revenue with a 9x return on ad spend. And the number of self-serve advertisers grew over 30% just this quarter. So I think in the case of Grab, fintech is the long game, but ads are really turning this into a serious monetization engine. So if we look at this from a balance sheet perspective, Grab is in a great spot. They're sitting on $5.7 billion in net cash liquidity, so that gives them plenty of fuel to keep scaling without having to raise money anytime soon. And as for the outlook, they're still holding firm on guidance. Their full year revenue is expected between 3.3 and 3.4 billion, and adjusted EBITDA between 460 and 480 million. So that's nearly 50% growth on the profit side. So in short, they're cashed up, they're still guiding for strong growth, and most importantly, they're sticking to their margin targets. So that right there is showing discipline. So what's the verdict here? Well, it looks like Grab is starting to do what every investor hopes for. They flipped to profitability while still growing over 20% year over year. So mobility and deliveries are proving to be sticky, scalable, and margin friendly. And while the fintech is still in the early stages, it's showing that the growth trajectory there is real. So if you're a long-term investor bullish on Southeast Asia's digital economy, Grab looks like one of the best ways to play it. And it's not just me that's saying that. Wall Street is starting to catch on. Check out these latest price target updates from Jefferies, Goldman Sachs, HSBC, Bank of America, and Bernstein. That's now multiple upgrades pushing above $6 and coming from top-tier firms. So to me, it's very clear that Grab is very undervalued and is a strong buy in the $5 range. So the stock is down since this earnings report, but I think this is a great opportunity to buy a great company which is undervalued. All right, that's it for now. If you enjoyed this quick update, please like and subscribe to Borex Investing for more. And if you're curious how I'm personally investing in Grab, be sure to check out my full deep dive, which I'll link at the end of this video. Thank you.